Thank you, Andy. Presenting on the industrial market, Matt McAfee, a senior associate with CBRE. Matt has been in the industry for 15 years. In the last 3 years, he has sold over 1 million square feet and leased more than 4 million square feet of industrial product.
Good morning. First, I'd like to start off by saying thank you to Lindsay Cleverly and Angela Eldridge for all their hard work in putting this event together. I would also like to thank my CBRE team, Kathleen McMillan and Shanna Green in our marketing department, our industrial researcher Mark Rogers, and lastly, I would also like to thank Tom Freeman and Kyle Roberts for sharing their insights with me on the market during my preparation. Okay, so jumping right into it, what's up on the industrial front? The following topics are currently making headlines in the industrial market: the inland port, current construction levels, lease activity and lease demand, the diversity and strength of tenants and users in the market, and e-commerce and related uses. I will dive deeper into each of these topics throughout my presentation. So first, what exactly is an inland port? There's been a lot of discussion around this topic in the last year or so, and I believe there still is some confusion about what an inland port actually is. A high-level description of how an inland port works is that shipping containers arrive at a seaport. Take the LA Long Beach port, for example. From there, they're offloaded onto a train and sent inland to an intermodal type hub. Once the container arrives, the inland port then allows for many of the same value-added services that a seaside port has to offer. And with this type of operation, there's also an array of related activities linked to the hub, such as drayage services, depots for containers and chassis, and warehousing and logistical facilities. Some examples of inland ports that you may be familiar with are Chicago, Kansas City, and Greer, South Carolina. Now that we have a better understanding of what an inland port is, I think it's worth expanding upon some of the benefits that an inland port has to offer. First, efficient intermodal transportation. Intermodal transportation is generally more fuel efficient than shipping long-haul freight, and rail transit times are becoming more comparable to over-the-road transportation. Multimodal services. An inland port can act as a merging point for the multimodal services used to distribute products. Multimodal meaning trucks, trains, and planes. Reduced delays. The driver and equipment shortages affecting most major seaports are creating longer delays, and an inland port can help companies alleviate these bottlenecks. Reduce costs. Warehousing and logistical services within close proximity to an inland port are generally cheaper and more readily available than those closer to a seaport. Value-added services. Some of the value-added services that can be provided are customs clearance, consolidation or deconsolidation, sorting, packaging, and assembly of products. And finally, access. Inland ports help provide more efficient access to inland markets, both for inbound and outbound logistics. So why would it make sense to have an inland port in Salt Lake City? Simply put, location. There'd be no other site like this in the Western United States. Salt Lake City has become known as a regional distribution hub with close connectivity to I-15, I-80, I-70, and I-84. We also have access to over 60 million people within an 11-hour drive. As shown here, there's also mainline rail connection to all 4 western seaports. And lastly, Salt Lake International Airport's current $3.6 billion expansion will help increase air cargo capacity. And now for the million-dollar question: where do we currently stand? The Utah Inland Port Authority was formed. Legislature passed a port bill to help plan and facilitate development of an inland port and its related uses. The 11-member Port Authority Board has been tasked with preparing a project area plan, and they have also been tasked to address the potential environmental, infrastructure, geotechnical, and security issues that may arise. Lastly, I think it's important for the audience to understand that the inland port, the Northwest Quadrant, and the SLC Global Port Logistics Center are not interchangeable terms. Hopefully you all now have a better understanding of what an inland port actually is. And in regards to the Northwest Quadrant, it's a geographical area, as shown here, that encompasses approximately 19,000 acres around the main industrial corridor of Salt Lake City. The SLC Global Port Logistics Center is made up of a group of private developers that have compiled approximately 3,000 acres within the Northwest Quadrant, where they plan to build approximately 45 to 50 million square feet of industrial product. Site work for the first 2 buildings of Phase 1 will be commencing soon, and I think it's important to note that this project will move forward regardless of whether an inland port comes to Salt Lake City or not. Next, I would like to walk through our record levels of construction and also show how the Salt Lake market has matured, the Salt Lake industrial market, has matured over the past few decades. Industrial construction has remained consistent since the tail end of the recession. And from 2012 to 2016, the market has averaged roughly 1.5 to 2.5 million square feet of industrial construction per year. As you can see here, there's been a notable uptick in both construction starts and deliveries in the last 2 years, with big box construction being one of the main contributors. In 2018, the amount under construction jumped to 4.2 million square feet, while 4.7 million square feet was delivered, and that was a 62% increase over the amount delivered in 2017. This is incredible growth and speaks to how much the market has changed. When I was on the development side back in the mid-2000s, the typical Class A big box building was classified as about 200,000 square feet. However, a change started to occur in the late 2000s when Freeport West started building 400,000 plus square foot big box distribution buildings. And at the time, many national developers thought that that footprint was too large for our market. However, it was certainly an if you build it, they will come scenario, and ever since then, that footprint has become the norm for big box construction in our market. I also think it's important to note that 52% of buildings that are 400,000 square feet or larger have been built from 2009 until now. So these next few slides are going to highlight the amount of expansion that the Northwest Quadrant has seen from the mid-1990s to now. Here you can see a handful of parks that were developed from 1994 to 2005. Majestic, Ninigret, Prologis, and IDI were a handful of the few active developers during this period. Big box buildings in our market were classified as 150,000 to 250,000 square feet. They had 24 to 28 foot clear heights, limited to no trailer parking, and tenant increments of 25,000 to 75,000 square feet. From 2006 to 2014, Freeport West started development of their landmark park. Buzz Oats started on Westport Distribution Center, and Price Real Estate began on their California Avenue buildings. Building sizes began to increase during this period to 250,000 to 500,000 square feet, with 28 to 32 foot clear heights, tenant increments of 50,000 to 150,000 square feet on average, and trailer parking started to be incorporated when sites would allow for it. An interesting storyline that has transpired from 2015 to now is the emergence of new developers to the market. While many existing developers continue to remain active, the entrance of new developers that are more commonly known for their development of other asset types has certainly made headlines. Boyer Company, Ritchie Group, and Wasatch Property Management are all under construction on 300,000 plus square foot buildings, and Seafried Properties and Hamilton Partners have also delivered sizable projects during this period. Typical big box sizes are now 400,000 plus square feet, with 32 to 36 foot clear heights, trailer parking, and tenant increments of 75,000 to over 500,000 square feet. And as many of you know, we've started to see buildings push closer to 1 million square feet, with Amazon, UPS, and Post Serial taking down large chunks of space. Looking ahead, some of the planned projects are the SLC Global Port Logistics Center, DLM and Kennecott's joint venture on 7200 West, and Hines project in West Valley City. We will most likely see 2 sizable land sites trade in 2019 as well. PRI's 68 acres and the 63 acres commonly known as the Dumke site, both of which are situated on 5600 West and I-80, have the potential to open up 2 additional sites for future development. Finally, building specs, at least in the near future, should continue to mirror what we have seen these past few years. Now let's take a brief look at lease activity and lease demand. With the current levels of construction, some may be getting nervous that availability and vacancy rates are on the rise. However, lease activity in 2018 remained healthy, with approximately 5.3 million square feet leased and 4.1 million square feet of overall net absorption. The 6.9 million square feet leased in 2017 was highlighted by 3 large lease transactions, which totaled just shy of 1.5 million square feet. And those deals helped push 2017 leasing to the highest level on record. The 12.2 million square feet of combined leasing that took place in 2017 and 2018 actually kept availability and vacancy rates at 4.7% and 3.4% respectively. This shows that the Salt Lake industrial market is maintaining a healthy balance between supply and demand. It should also be noted that the lid has come off the market in terms of overall deal size. When you look at this particular chart, you will see that the average deal size in our market has been increasing over the past few years in both the 50,000 to 100,000 square foot and the 100,000 plus square foot increments. It wasn't that long ago that a 300,000 plus square foot requirement was something that only came to our market once every few years. However, we're now starting to see deals of this size come to and land in our market each year. And you can also see here that from 2012 to 2016, there were 31 deals done over 100,000 square feet. And from 2017 to 2018, there were 30, which further drives home the point that deal size in our market is on the rise. And lastly, as it pertains to leasing, I think it's important to note that we continue to see a diverse mix of users in the market. While e-commerce users continue to remain active and grow their base, aerospace, life sciences, consumer goods, and 3PLs also remain very active. So next, I'm going to touch on e-commerce and a related use that's starting to create additional industrial demand. I'm sure many of us in this room can relate to this image here. I kind of view it as adult Christmas, but in my house it comes around way more often than once a year. Most times it's due to our bad habits of ordering multiple items of varying shapes and colors and sizes because we can always send back the ones that don't fit or that we don't like. Either way, the items that we package up and ship off are about to enter the complicated and expensive field of reverse logistics. Reverse logistics is the movement of goods and services and the management of resources after sale and delivery to the customer, which would include products being sent back for repair and or return. Historically, retail returns average 8% of total sales. However, e-commerce return rates are much higher, coming in at 15 to 30% depending on the product type. And it's estimated that returns either sold at a discount or that are discarded cost retailers 4.4% of total revenue each year. Online sales during the 2018 holiday season were estimated to be approximately $123 billion. And with the return habits of most, that would then equate to $37 billion in returns. To put this into perspective, with an average price of $82 per package, this equates to 390 million packages being sent back through retailers' distribution networks. For retailers with both online and brick-and-mortar presence, encouraging customers to return an item to a store is a high priority, and this comes with two benefits. First, shipping and handling costs are significantly reduced, and second, an item returned to a store is often resold. Nonetheless, today's consumers increasingly prefer to ship back their returns, which has a significant impact on retailers' supply chain networks. The solution to the reverse logistics problem is improved and expanded supply chain networks. This will create additional industrial demand as users add more warehouse space to handle the reverse flow of inventory. It's estimated that a reverse logistics supply chain can require up to 20% more warehouse space than an outbound supply chain due to the manual and unpredictable nature of returns. Third-party logistics providers, also known as 3PLs, are also positioned to benefit from this increased need for warehouse space, as many retailers seek to outsource their reverse logistics operations to cut costs and gain maximum efficiency. 3PLs have become a major driver of industrial real estate demand over the years, and a study completed by CBRE Research found that 3PLs accounted for more than half of the 100 largest warehouse leases completed in 2018. It's also estimated that 3PLs occupy nearly 700 million square feet nationwide, and they're growing this footprint by 3 to 5% annually. This further indicates that they are well positioned to take advantage of reverse logistics opportunities. So where are we headed? Both short and long-term projections for the Salt Lake industrial market are very good. While we may experience some minor short-term hiccups, the strong economic story and current levels of growth we have experienced will continue to move the industrial market on a steady upward course in 2019. The historic construction and levels we have seen will also continue on in 2019, and while land and infrastructure constraints may pose challenges, we feel that this will only help to open up opportunity in other areas along the Wasatch Front. Thank you for your time.